Hi everybody, today I'm going to share with you a REIT that since IPO in 2007 until today, the dividend never dropped despite going through the global financial crisis, despite going through the COVID-19 situation. If you hold this REIT since IPO until today, the dividend collected actually is more than the price to pay. Okay, the capital come out during the IPO. Actually, a dividend collected is more than 100% of the principal invested. And what REIT is this? This REIT is none other than ParkWay Life REITs. Okay, so we can look at ParkWay Life REIT. You can see that they start to grow from 2007 just by purely focus on hospital in Singapore and start to enter in the Japan market. So the A asset have actually grown by close to 100%, where from a 1 billion now to a 2 billion asset, which listed in Singapore. And this is what they have now. In total, they have currently about 53 properties, okay, in Singapore and Japan, plus of course one medical center in Malaysia. Okay, and their portfolio size is about 1.99 billion. From this side, you can see that about 60% of the income is generated from Singapore, okay, which is the hospital, and 40% is from the nursing home in Japan. And look at this is the three hospital listed in Singapore, and it's a famous hospital. I think most people know of these three hospital. One is called the Gleneagles and Mount E Hospital and the ParkWay East Hospital. Okay, these three hospitals contribute about 60% of the REIT's income. Okay, and also in a way it's a dividend. Okay, what is so good about these three hospitals is they are on a long-term triple net lease. Okay, so it's a 15 years plus 15 years triple net lease. So what does this actually mean is when the hospital is being rent out already, ParkWay Life actually no need to bother too much. Master lease have to take care of the insurance, have to take care of maintenance, they have to take care of everything. And every month they just need to pay ParkWay Life REITs a rental income. And this rental income is escalating. What do you mean escalating? There is a CPI plus 1% rent review formula for this property. So what does that mean? This indirect means what? Almost guaranteed that the rental income can only increase every year. Okay, imagine you buy a REIT that they tell you that their income collected every year only go up. So what will that translate to your dividend? Indirectly means your dividend will only go up. Okay, so this is why this will have been done so well over the past more than 10 over years. Okay, but do take note, these three hospitals only contribute about 60%, okay, of the income. Okay, what about the other 40%? This is the Japan property. And you can see they got about 50 property in Japan, practically spread across the 4 main islands in Japan, okay, and scattered around the whole of Japan. Okay, and this property are mainly focused on nursing home. Okay, mainly on the nursing, as we know that Japan is an aging population. Okay, aging population, and nursing home definitely will be in a big demand. So they are diversified across different nursing home operator. So they don't bank on one nursing home operator. They got 27 nursing home, highly qualified nursing home operator they rent it to them. Okay, in Japan. Okay, they rent it to different nursing home operator, and this cause a diversity. So if anything happen to one operator, okay, they still got other 20 over operator to run the other properties. And one thing a bit unique of the agreement with the operator with the master lease in Japan is it is only have a up only rental review provision for most of the nursing home. In fact, more than 80% of the properties, okay, they rent it out in Japan is only up only. What do you mean up only? Means that the rental can only go up, cannot come down. Okay, so this is what we mean by up only thing. Okay, and thus indirectly it also means that the rental income can only go up, and you will translate to be what your dividend can only go up in a way. And do think of this is 40%, plus there are 60% from the Singapore hospital. Both are in this type of very favorable structure to the investor, which why result in ParkWay Life REITs, the dividend have been growing up, okay, since IPO to today, even despite the global financial crisis, the share price have dropped, but the dividend have went up. Due to COVID-19, the share price also have a dip, but your dividends still go up, okay, because of the structure of the rents. Okay, so let's look at their balance sheets. Their total assets about 2 billion, and their gearing is actually pretty healthy. It's about 37%, okay, for these REITs. So it also means that there is also room for expansion for these REITs. And let's look at, this is the track record of their dividend. You can see that their dividend over the years only go up, and from IPO to today to actually to last year, FY 2020, actually it went 118.2%. So what does it mean? Means you put in $1 to buy the shares at IPO, you get back $1.18 in dividends. Okay, so whatever actually in the market now is all purely 100% profits. And what about the share price? So this is the share price. You can see that the share price at IPO at $1.28, okay, and it have already hit $4.94. Okay, that's a all-time high, history high. Already have fall back to about 470, 480. So it actually make a very good, decent capital gain along the year also. Okay, and this is a summary of how the total return you will achieve. Okay, if IPO at 128, total you make 363%. Okay, total you make 363% returns over the year, and this is based on the price of $4.42. Okay, so that is so good about ParkWay Life REITs. Okay, but do take note, this is their past performance. Okay, they have been in the market for so many years. They passed 14 over years. They past performance. As I mentioned, that they got 3 hospitals in Singapore. They contribute 60%, and it's on a long list of 15 years. Okay, so this 15 years will end in August next year. Although they have option to extend a 15 years, but they need to renegotiate the lease. Okay, and the good thing is they already announced a renegotiation already done. Okay, and this is what have they announced recently is the new master lease agreement, okay, with the sponsor on these 3 hospitals. Let's look at this new agreement, but do take note, this new agreement still need to go for a EGM to get shareholder approval. Okay, then it can go through. Okay, but what is the new agreement is, this new agreement is ParkWay Life were able to extend the lease, not 15 years, another 20 years. Okay, so it's good news for investor in a way that, oh, you know that as the mid 20 years and also come with rent escalating formula, and the rent will continue to increase. So this is a good news to investor. But do take note of this agreement also, they need to come out about 150 million to do some enhancement work on the 3 hospitals. Actually mainly focus on Mount Elizabeth Hospital. Most of the money will spend there to enhance it. So this money will need to be raised by ParkWay Life themselves. Okay, not the sponsor. So ParkWay Life will need to fork out 150 million over the next 3 years to do enhancement work on the 3 hospitals. Okay, but they were going to take this mainly from debt financing. I mean, they were going to borrow money to help that, but that will indirectly impact the gearing. Okay, that's one part. Okay, but and also during this 3 year enhancement, they need to give rental rebate to the hospital. But despite that, you can see that from this chart, you can see that despite that, the rental income, the dividend income they collected is still increasing every year. It's still increasing every year. Okay, and the rental still increase despite they need to give a rental rebate because they reset it at a higher base. Okay, at a higher base. And once everything is completed, once the 3 years enhancement work is completed, the rental will restore back to the original one, will be 99.2 million. So you can see that is a rental growth of 39.6%. Okay, so this is a good thing, and thus the 150 million actually to me is very well spent. Okay, and it's not going to spend at one time. You're going to spend over 3 years, so it will not be really taxing to the REITs. Okay, it will be progressively come out, and at the same time they are collecting the rental income. Okay, so this is, and let's look at what will happen. Okay, what will happen after they do the enhancement. Initially you look at it. Okay, let's look at what happened. So you can see the DPU now is 13.79. Okay, when they start work, okay, next year when they start with the new agreement, okay, new agreement, the DPU will increase by 14.3, and by the end of 3 years where they have do the enhancement finish, the DPU will go by 18.26. So you can see the DPU actually increased by quite a significant amount. Okay, 13.79 to 18.28. Okay, it is close to a 4-cent increase. Okay, it is close to a 4-cent increase. It's close to a 30% increase in DPU. Okay, so this is something you need to take note on that. Of course, the dividend yield will definitely go up, but this assume the price stays stagnant. I personally think that the price unless it stays stagnant, if the DPU were to able to increase so high, okay, over the next 4 to 5 years. But do take note, this is based on projection. Okay, but let's look at the other parameter is what about their gearing and NAV. Okay, so their NAV currently is about 196. Okay, after the whole thing is finished, the NAV will increase to 249. Okay, 249. So how much have the NAV have increased? The NAV have increased by about more than 20%. Okay, the net asset value will go up by more than 20%. Okay, as you see, when talk about REIT side, if the NAV go up, what will happen to the share price? Usually the share price will go in tandem with the NAV. Okay, so indirectly we can say this may be a potential upside for the share price. Okay, but what about the gearing? The gearing is 38.5% now. Okay, despite they need to come out borrow 150 million to go and do the enhancement work, but you look at it, ultimately the gearing actually have come down. Okay, so why is that so? Is even they come out money to do it, because when they come out the money to do the enhancement work, the value of the property, okay, actually increase. The value of property actually increase, and due to better insight of their future rental income, so the property value are expected to increase, and this actually resulted in their gearing actually drop. Okay, as gearing is a formula between the debt and the value of the property. The value of the property increase will be able to overcome the money that's spent. So everything look very rosy, okay, for ParkWay Life. Okay, and when it comes with this rental agreement, they also come with this thing called right of first refusal. Okay, because when it comes to REITs, we also think that the REITs need to grow. Okay, need to grow. Remember, ParkWay Life started with only 3 hospitals in Singapore, and they went over to Japan to buy 50 properties in Japan, plus 1 property in Malaysia. Okay, now they have increased to 50 over properties. Initially, the revenue is 100% from Singapore. Now the revenue from Singapore has dropped to 60%. Okay, so this is how ParkWay Life has grown over the past 14 over years. Okay, then what is the next phase of growth? Okay, so that's what everyone also want to look at it. Okay, because you don't want to buy something REITs that actually don't grow over time also. Okay, so they come up with this thing called right of first refusal, means that the sponsor will give ParkWay Life REITs the first right to what? Acquire Mount E Novena. Okay, Mount E Novena. As everyone knows, that healthcare REITs invest in Singapore hospital will definitely be a very good investment for the REIT investor. Okay, so if they acquire Mount E Novena, that will be a very good news to investor. Okay, so do take note, this is on paper. Okay, but they are given being 10 years a period to acquire. However, we also need to look at the practical aspect. Are they able to acquire this hospital, or will they be acquiring this hospital in the near future? The right of first refusal granted by sponsor to ParkWay Life IPO has expired 2012. Okay, there are certain rights to acquire some properties, but now is we want to look at, are they able to acquire? Because when they want to acquire property, they need money. Okay, they need money to acquire. So where does the money going to come from? Let's do a simple analysis. Okay, so let's look at the properties, hospital property in Singapore. How much are they valued now? Okay, how much are they valued now? You look at Mount E is 751 million. Okay, this is based on their December 2000 reports. Okay, Glen Eagle is about 395 million. Okay, ParkWay East Hospital about 6.7 million. Okay, so all add together, it contribute about less than 1.2 billion. Okay, well, 1.2 billion is about 60%, slightly more than 50% of the total asset of ParkWay Life REIT. Okay, so ParkWay Life REIT, take note that total assets is about 1.99 billion. Okay, so this is total about 1.2 billion. Now, what is the value of Mount E Novena Hospital? Okay, so that is another thing we need to take note. So I went to a sponsor website, I look at their annual reports. Okay, the sponsor IHH. Okay, and they got this list of top 10 properties, and we can see that Mount E Novena is worth about 3.9 billion ringgit. Okay, because it is a Malaysian company, so it's reported in ringgit. So if you were to convert it to Sing dollars, okay, That's based on current exchange rate. It worth about $1.2 billion. Okay, $1.2 billion. So how much does this Maui Novena Hospital cost? This Maui Novena value of 1.2 billion is the total value of the 3 hospitals that's listed in ParkWay Life. Okay, so and what is the total asset of ParkWay Life is about 1.99. So actually, this Maui Novena is actually 60% of the total asset of ParkWay Life REITs now. So as a REIT, we know that they pay out 90%. In fact, ParkWay Life pays more than 90%, okay, of their income out to investor. So how are they going to acquire this hospital? Okay, let's look at their debt headroom. This is their debt headroom based on 30th of June. Okay, we know that MAS have a gearing cap of 50%, so unlikely ParkWay Life would need to stretch to 50. Let's assume they stretch to 50. They can only borrow 523.6 million. So they still short of what? 700 millions, okay, to buy these properties. So task where to get this money? So there's a chance that if they were to acquire this money, they will need to do some equity fundraising. Okay, they will need to do equity fundraising, and 700 million is not a small amount, okay, compared to the size of the REITs. If this REIT is a $15 billion REIT, then of course 700 million is not really that significant. But this REIT is only 2 over billions, okay, 2 over billion. So a 700 million REIT were to acquire, they need to do equity fundraising to raise about 700 million, will be pretty tough. Okay, now of course they may use perpetual security to do that, but ultimately equity fundraising from the investor will be expected if they want to buy this. Okay, so you have to look at it. Where are you now? If you are a retiree collecting dividends, okay, then if there's a massive equity fundraising, is this asking you for money? Okay, so this is something you need to take note. But if you are a working adult, I think if they do equity fundraising to buy Novena, I think it's a good move, because you know that at least you'll grow further and your dividend will increase further. Okay, so this is something you need to take note of that, okay, when looking at ParkWay Life REITs. In conclusion, actually this REIT to me is still a very good REIT. The only main concern is how are they going to acquire that hospital. Okay, when they do equity fundraising, when they do a big equity fundraising, how are they going to make it yield accretive, DPU accretive, okay, for this instance. That's all I have to share today. So if you feel that you benefit from this video, do like and share this video, and also do remember to leave your comment below. And also do remember to subscribe and press the bell button so that you'll be notified on the next video. I shall see you in the next video. Bye bye.